It's December 2001. You walk into your bank, same account, same balance. Nothing looks different. At least, that's what you think. You stand in line, wait your turn, step forward, and ask for your money. The cashier looks at you, hesitates, then says something that doesn't make sense. You can't take it out. You pause, confused. Maybe you heard wrong. You ask again, and this time, they're clearer. You can only take a small amount, not all of it, not even most of it, just a fraction. And in that moment, something feels off. Because your money is still there, but suddenly you don't control it anymore. This actually happened to millions of people across an entire country. And it didn't happen slowly. It happened overnight. But like every financial collapse, the real story started long before that day. In the 1990s, Argentina made a bold move. They tied their currency to the US dollar, 1 peso equal to $1. At first it worked. Inflation dropped. Stability returned. Confidence grew. People trusted the system again. Everything felt under control. But underneath, a dangerous imbalance was building. Because to maintain that system, the government needed discipline. They needed to control spending, limit debt, protect their reserves, but instead, they kept spending. They borrowed more, and slowly, the system became fragile. By the late 1990s, cracks started to appear. The economy slowed. Unemployment rose. Investors began to lose confidence. And then something even more dangerous started happening. People began pulling their money out of banks. Not all at once, not in panic, but gradually, quietly, because deep down, they felt something wasn't right. And that's when the government made a decision not to fix the system, but to stop the exit. In December 2001, they introduced a policy called which sounds small, almost harmless, but it changed everything. Because suddenly, people could not freely access their own money, withdrawals were limited, transfers were restricted, and the system tightened its grip. At first, people didn't panic. They thought it was temporary. A short-term measure, a quick fix. But then days passed, weeks passed, and nothing changed. People still couldn't access their savings. Bills kept coming. Life kept moving. But their money was trapped. And that's when fear turned into anger. Long lines formed outside banks. People demanding access. Demanding answers. But there were none, because the system wasn't designed to protect them. It was designed to protect itself. And then everything escalated. Protests filled the streets, crowds grew larger, voices got louder, and eventually riots broke out. The entire country was in chaos. Because this wasn't just about money anymore. It was about control. The realization that what you thought you owned could be taken away without warning. But here's where it gets even worse. Because locking the money was only the first hit. Soon after, the government abandoned the dollar peg and the currency collapsed. The peso lost massive value. So even when people finally regained access, their money wasn't worth what it used to be. Think about that. First, you can't access your money, then it loses value anyway. This is how financial collapse works. Not one blow, but two, access disappears. Then value disappears. And by the time people understand what's happening, it's already too late. But just like every crisis, not everyone was affected equally. Those who held physical cash had options. Those who had assets outside the system had flexibility. Those completely dependent on banks had none. Because here's the truth. Most people ignore money in the bank is not the same as money in your control. Banks don't just store money. They use it. They lend it. They depend on the system functioning. And when that system breaks, your access disappears with it. Now look at today. Everything is digital. Online banking, mobile apps, cashless payments. More convenient than ever. But also more centralized. more controllable. Because if access could be restricted in 2001 with less technology, what could happen now? Again, this doesn't mean collapse is guaranteed, but it does mean something important. The mechanism exists. The system has the ability to restrict access, and history shows when that ability exists, it eventually gets used. The real question is not, will this happen again exactly the same way? The real question is, if access disappears, even temporarily, what happens to you? Because in 2001, millions of people believed they were safe, until one day, they weren't. And by the time they realized it, they had no control left. That's the reality of financial systems. They work perfectly until they don't. And when they fail fast. Faster than most people expect. The only difference between those who survive and those who don't is simple. They understand the risk before it becomes reality.